QuickBooks Pro Desktop 2021. Foreign currency accounts payable maturity transactions. Let's get into it with Intuit's QuickBooks Pro Desktop 2021. Here we are in practice problem 4, multiple currencies. We currently have the open windows open. You can open the open windows by going to the view dropdown, selecting the open windows list. Let's see where we stand at this point in time by looking at the balance sheet, going to the reports dropdown, company and financial. Take a look at the balance sheet standard, that standard balance sheet. Customizing the reports up top from 010121 to 123121, and then we'll say okay. So this is what we had in our scenario. We purchased a piece of equipment up here, machinery and equipment. We paid for it on account, or we haven't paid for it yet. We have a liability and we're going to be paying for it. That increased the accounts payable. We will also be paying for it in foreign currency. So that being Australian dollars, 100,000 Australian dollars. In order to mitigate that risk, we also put a forward contract on the books, increasing the receivable in foreign currency and another payable to the exchange broker. We dealt with those last time. We still need to do an adjusting entry related to them. We're thinking about now the maturity of the accounts payable that's in Australian dollars related to the original purchase of the machinery. So let's see where we are thus far at this point here. So I'm going to double click on that 61,000 where we can see we entered the original bill when we purchased the machinery. We put this on the books using this time the spot rate. So the $100,000 in foreign dollars, the Australian dollars we're going to pay. We then valued using the current spot rate at that point in time, not the forward rate. And then we made an adjustment for it at the end of the period with our adjusting entry so that we are correct as the financial statement date. Now we are considering the date in which we will be paying this thing off. Now we did this in Excel as well. If I go back on over to Excel, we're talking about this transaction now when we're paying off the payable. But it'll be a little bit different once again in Excel because we did this adjusting entry up top in order to first adjust the balance to the balance that will be paid off so that we can then just do a journal entry paying the entire thing off with two accounts. It'll be a little bit different over here when we go into QuickBooks. If I go back to the home page, and that's because this payable, you can imagine it, we entered a bill for it, and then we're going to pay the bill. We want to make it as easy as possible on the accounting process. So when we do our adjusting entry, messing things up in the middle, messing the process up, because if I wasn't to do the adjusting entry, if we didn't have to do one, if it didn't go over the cutoff period where we needed an adjusting entry, say the end of the year, then we could just simply enter the bill and then pay the bill, and QuickBooks would record the proper amount of gain loss for us at that point in time for us, but it would be on that income statement. If we need an adjusting entry to break out the amount of the gain or loss that's in the year 1 and year 2, then we're going to do it by doing an adjusting entry, then a reversing entry, so that the logistics of the bookkeeping can be just simple enter bill and then pay bill transaction as it normally would be. So let's see what that will look like here. And so we're going to go back on over to the balance sheet. So that's what we have at this point. We've got this payable that we're going to be paying off. We want to make sure that anytime we're going to pay off the payable, that we have the proper spot rate that we're going to be using at this point in time. Now we already said it last time, but let's check it again. Lists drop down. We're going to go to the price list or the currency list, and then the Australian dollar. Now, if we were doing this in today's time, if this was today that we're getting the spot rate, then we would go to the accounts drop down or rise up, download the latest rates, which would be the spot rate. Here, it's a practice problem. We're working in the future. Therefore, I'm going to double click on the Australian dollar, and there's the 331.22.602. That's the rate we want. So because we entered that last time. So there it is. There it is. That looks good. So I'm going to say, okay, that looks good. Closing this back out then. We have everything we need. Closing this back out then. Let's go back to the home page, and we'll do this by entering the bill now. So we entered the bill. Now we'll pay the bill. We're going to pay the bill that we entered last time. Paying the bill. We're going to pay the bill now out of the accounts payable for the Australian dollars. We want to pick up that one. This is the bill that we need to be paying. So that's the bill that we need to pay. We want to pay the right bill. If we don't pay the right bill, the other bill gets mad. So then we're going to be down here on 331.22. That's correct. The rate at the 0.602, that's correct. Looks good. And we're going to be paying the bill. I'm going to pay it out of the Australian checking account. So we put the money into the Australian checking account. We're now going to be paying it out of the Australian checking account. Okay, so what's going to happen at this point in time? The pay bill means that we're going to be decreasing the cash. So cash is going to be going down, going to be going out of the account that we set up in Australian dollars, which actually has 100,000 Australian dollars in it. But the cash equivalent at this point in time, given the current spot rate, is that 60,200. The other side then is going to be paying off the accounts payable, and it'll bring the accounts payable down, but we'll still have a balance in there. So in other words, let's do that one more time. We're going to be decreasing the accounts payable by the 60,200. I'm sorry, we're decreasing the accounts payable by the amount that's in the accounts payable based on the exchange rate that we had when we first bought the equipment. Then we're going to be increasing or decreasing the cash by the 60,200, which is this amount here. And then the difference is going to be going to the gain or loss. It's going to record the entire gain or loss between the point in time that we started the transaction, the first transaction when we put it on the books, and then the point in time that we're paying it, ignoring, it's not going to take into consideration that middle transaction where we did the adjusting entry. Therefore, we're going to just need an adjusting and reversing entry. So let's see what that will look like. We'll say save the bill, pay the bill, save the bill, pay the bill. I'm going to just call it E4 and then OK. And yes, I think that is good. Closing this back out, let's go on over to the balance sheet now. Let's change the date up top to 2022. And so I'm going to say OK. And now we have the foreign currency account went back down to zero. The checking account went up and back down. We'll take a look at that in a second on the trial balance. We still have $300 in the receivable. So if I double click on this receivable, we still have that $300 in there. And if I click on this item and I go back to 2021, that's because we put it on the books at the 60,900. And then when we paid the bill, it took the full amount off at the 60,900. It didn't account for the adjusting entry. The adjusting entry made it correct for us as of the cutoff, but kind of messed us up with regards to the normal type of process. So what it did, it took the 60,900 off the books here, and it put the other side into the checking account. Let's look at this on the trial balance. It'll make more sense by going to the reports drop down. Accounting and taxes, take a look at the trial balance. I'm going to change this from 010122 to 123122. And then in the Australian checking account is where the other side is. If I go into there, then we see the bill payment went down by the 60,200. And the difference between the two, it put to the gain or loss down below. The difference is going to the gain or loss for the paying off of the receivable, which is right here. It's going to be that 200. Now that 200 is taking the full difference. Then if I go back and say, well, what happened with the trial balance over here with my Excel worksheet, when we took the receivable off the books, we had, or I should say when we took the payable off the books, we had this adjusting entry up top of the 1,000 and then this other transaction of the 800 allocating between the two periods of the 1,000 up top, the 800 below, netting out to the 200. So what QuickBooks did is it took the full amount of that 200. And what we really need to do is allocate it out between the two periods, 1,000 year one, 800 year two. We had a loss in year one, a gain in year two. So we did that. If I take this back on over to 2021, we can see that we had a closing entry. Let's do it this way. I'm going to close this to 2021, 12/31/21. Then this $700, if I go into that item, includes the adjusting entry for the 1,000. So we have the adjusting entry up top, which includes the 1,000, making it correct prior. And then if I go to 2022, so it's correct as of the end of 2021, 12/31/22, then we have this 200, and that 200 should be 800. So if I reverse the 1,000 here, if I do a reversing entry, and it'll net out against that 200 to make it the proper amount, the 800. Gets a little bit confusing because we have two separate items in here that are kind of muddying things up. But we'll talk more about that next time. We'll do the reversing entry, which will make these two items correct in terms of the allocation of the gain or loss between year one and year two. And on the balance sheet, it will then remove, if I go to 010122 to 12/31/22, it'll remove these amounts here, the 300, which should be down to zero in the receivable in the Australian units, and the accounts payable, it should be down. The fact that there's a balance remaining in these two is an indication that there's a problem, usually with that adjusting entry. We didn't reverse it. So I want to show how it kind of doubles up here, and then we'll do the reversing entry, which should bring these two back down to 0, and it should record the proper allocation of the gains and losses to the proper years, year 1 and year 2.